today we're going to talk about Chapter 3. Chapter 3 covers the adjusting process. The focus of the text is on the accrual basis of accounting. The basic idea of the matching concept was presented in Chapter 1, where expenses incurred are matched against the revenue. And Chapter 3, we're actually going to expand on that idea. All of the accounting concepts and principles introduced in the earlier chapter, matching is the most important, and that's why we're going to essentially spend an entire chapter on it. So this chapter, we're going to cover 4 different objectives. That's where we'll focus all of our work at. And we'll start out with Objective 1. Objective 1 is describe the nature of the adjusting process. And under this objective, we'll need to revisit, of course, that matching concept from Chapter 1. The matching concept is necessary in order to match revenues and expenses in the proper accounting period. If the concept is violated, the financial statements for the period will not be accurate. And the adjusting process discussed in this chapter is critical to conforming with the matching principle that we talked about. Okay. So we have a couple of ways that we can account for our business transactions. Accrual basis of accounting is what we are going to focus on. And this, as you can see, is revenues are reported on the income statement in the period in which they are earned, regardless of whether or not we got money or not. We report them when we earn them. And this is part of the revenue recognition concept. And the other form is the cash basis. Cash basis is used most by individuals, okay, and that's for tax basis. That's what we use. We use the cash basis. And it's also used by some service providers such as doctors and lawyers. If you go into an office and you see the sign that says payment is due when services are rendered, then that's because they're on the cash basis. Okay, but usually it's just doctors, lawyers, dentists, those types of businesses that will use it. So similar to personal expenses, not all business expenses are paid monthly. If a business wants to know its true expenses for the month, it must consider all expenses incurred, not just those expenses that were actually paid. Okay. So these are some of the things that we need to adjust. Of course, the expenses that are not recorded daily, revenues and expenses incurred as time passes rather than as a separate transaction. So some examples for the first one, expenses that are not recorded daily. We use paper clips and we use paper daily, but we don't actually record a journal entry every time we use a paper clip. Okay, so once a month we will do what we call an adjustment to determine how much of our supplies have we used. And we'll do one entry instead of an entry for 2 pennies every time we use a paper clip. For the second one, revenues and expenses are incurred as time passes rather than as separate transactions. So this may be something like if you pay your insurance in advance for 6 months, like you pay your insurance premium. So what happens is every month you use a portion of that insurance and it becomes an expense. Okay. Another is some revenues and expenses may be unrecorded, and this is a really good example of this is at the end of the year ends on a Wednesday, but we pay our payroll on Friday. So we have to record our wage expense that we've had for Monday, Tuesday, and Wednesday, even though we may not actually write a check until Friday, which would be in the new year. Okay, so so this all pertains to the matching concept. It states that all expenses incurred in providing a service or selling a product must be recorded in the same period that the revenue from the service or the sale is recorded. Expenses are matched against the revenue that they generate. The matching concept and the accrual basis of accounting go hand in hand. And because of these concepts, some accountants must be updated at the end of the accounting period to show the correct revenue and expenses. And that is what we call our adjusting process. Okay, and we do the adjusting process through adjusting entries. Okay. All right, so some types of accounts that require adjustments are like prepaid expenses. Okay, that would be like our insurance. We paid it in advance. Unearned revenues. These are advanced receipt of future revenues and are recorded as liabilities. So a really good example of this would be like magazine subscriptions. When you get a magazine subscription, you pay for a year's worth in advance. And then they slowly give you your magazines throughout the year. Okay, so for the magazine company, that subscription is an unearned revenue. And so what it does is it creates a liability for the company. They are required, they owe you either your money back or magazines. Okay. The next is accrued revenues. These are unrecorded revenues that have been earned for which cash has not yet been received. An example of this is you've done the work for a company and you just haven't billed them yet. Okay, so they haven't paid you. Or you've billed them and they just haven't paid you. Accrued expenses are unrecorded expenses, and that's like the wages that I talked about. All right, so next we can talk about Objective 2, which is journalizing the entries that require adjustments, okay? So in your book, the best thing to do is to go through Objective 2 because they give you examples of each one of these types of adjustments that are needed. So you want to go through those examples, take your time, really read what's going on and how they actually create those journal entries. All of those adjusting journal entries are based off of this unadjusted trial balance for net solutions that we completed in Chapter 2. And they'll go through each of these accounts and they will analyze them and decide if they need an adjustment. Okay, so if you'll go through the pages in Objective 2, you'll get a better understanding of the actual adjusting entries. Now, if you'll notice here, this is the new chart of accounts after we do our adjusting entries because we actually introduced some new accounts through the adjusting process, and those new accounts are in red or pinker. I do want to talk a little bit about depreciation because this is a new concept. Depreciation involves fixed assets. These fixed assets are physical resources owned and used by a business and that are permanent or have a long life. So fixed assets are normally building, equipment, land. Okay, those are the most normal types of fixed assets: building, equipment, land. These types of long-term assets will lose value over time. This decrease in usefulness is what we call depreciation. So depreciation is one of our adjusting entries where we adjust how useful that fixed asset is to us. Okay. So all fixed assets will depreciate except for land, the actual land, not the building it's on, the actual land, the earth that it is on. Land does not lose value. It's not going anywhere. So as fixed assets depreciate, we will take a portion of it and record it as an expense because every year it loses just a little bit more usefulness to us because it just gets older. Okay, so accumulated depreciation is the new account that we introduce, and this is a contra asset account, meaning opposite. Contra means opposite. So if assets have a normal debit balance, then accumulated depreciation has a normal credit balance, the opposite of. That's why we call it a contra asset. Okay. All right, book value is another concept that's extremely important to understand. Book value is taking the price that you paid for it, okay, original cost, and subtracting any depreciation that you've had. What's left over is the book value of an asset. So it looks like this. Book value is cost minus depreciation. Okay. All right, so looking now at Objective 3. Objective 3 is summarizing the adjustment process. So this is going to put all of those journal entries that they introduced in Objective 2. They put it in one spot so you can kind of get the whole picture. Okay, so Exhibit 8, 9, and 10 are extremely important in the chapter. Okay, it kind of puts it all in one spot, which is really nice. These are the journal entries that happen and how they affect each one of the accounts. Okay, going through each type. And here they are all in one spot. And then we also post these entries. If you'll notice the post reference column right here, we post those entries to the general ledger as well. And once we have our general ledger complete, which you can see in Exhibit 9, we can then move on to Objective 4, which is to prepare an adjusted trial balance. The great news is the trial balance is done in the exact same way that it was introduced to you in Chapter 2. The only difference is now we do another one after the adjusting entries. We do it for the same reason, just to prove that our debits and our credits are equal. Okay? And then we can prepare our financial statements. So if you look here, the ones in blue are the accounts that were changed from our original trial balance at the end of Chapter 2, based on our adjustments. But it's done the same way. We do them in order from our general ledger. We write our balances in there based on what's in the general ledger, and we add our debits and our credits to make sure that they equal. We will have one more trial balance, and that'll be a post-closing trial balance that we'll introduce in the next chapter. So this has been a very brief review of what is important in the adjusting process.